Why might a country go into an economic or financial crisis? Perhaps it mismanaged its economic policies. Maybe global demand for its exports, say commodities, went down rapidly, or it faced a natural disaster. As a result, the country is no longer able to pay its bills like debt payments or public sector salaries. What does the country do? The IMF was established more than 70 years ago precisely for this reason, to provide emergency financing and help countries stabilize their economies. Without such financing, the impact on the country and its people would be much worse. Countries often come to the IMF when they have no other lending options. Private investors and banks may be unwilling to risk giving money to a troubled country. The IMF provides short-term loans at an interest rate much lower than the market. It also provides zero-interest loans to poorer countries. Because IMF lending is fast and flexible, it gives countries breathing room by allowing them to meet their immediate financial needs. That breathing space gives time for new policies to have an impact. The IMF works with countries to resolve issues that led to the economic crisis in the first place in a way that puts the economy on a firmer footing, while paying attention to protecting the poor and vulnerable. These groups are typically affected the most by crises. The IMF's involvement sends a strong signal of support among private investors and banks. This helps give investors the confidence to come back and invest. Regaining this source of financing further helps the country get back on its feet. The IMF currently has lending arrangements of about $185 billion with 36 countries, enabling them to strengthen their foundations for inclusive growth that benefits all citizens.